Liberty Home Equity, January 25th. You're going to learn everything about reverse mortgages, HECMs, the refis and the purchases.
Yes.
You know, Frank, you brought up something really great about reverse mortgages because there's a lot of pushback or some pushback from the industry saying, well, the market hasn't hit or I don't do these a lot. And we both have aging parents.
Yes.
And you brought up a great point. Learn them not just for the business benefit, for which there is a ton, but learn them to be an asset to your aging family.
Yes.
I'll tell you, I'm going through it right now, guys, and it's remarkable.
Yeah.
So check this out on the 25th. It's good for your business and your home life. Click this banner right over there, or on Facebook. It's somewhere right up above.
There you go.
Below your profile pic. All right, Frank, here's what I like about our viewers.
Besides their stunning good looks.
Besides their stunning good looks. And their veracity to drink a ton.
Yes.
They're all so damn smart. And I'm not pandering here.
Okay.
I'm not pandering.
Okay.
You guys, you're smart and you're logical. Now, here's my point. We did a show yesterday, and I told you MGIC is not going to do 45 back-end plus ratios with scores below 700.
Right.
They said they're concerned, which is a real interesting thing to put into a memo. They are concerned about this, as am I.
Sure.
We're writing loans that are painting people into corners right now, guys. I hope your car doesn't break down. I hope the AC works great this summer.
Right.
Because if something happens for a lot of you out there, you're screwed.
That's right. I mean, stare at this. 57% of you have less than $1,000 in the bank right now. I mean, what if your car breaks down and you can't fix it? I mean, it might cost like $4,000 to take care of it.
Right.
I mean, you know what you're gonna do at that point?
I do.
Most people at that point are gonna trade in that dud lemon, right? And they're gonna go get a new car with no money down, okay? Because you can make that $538 payment for a new car, but you can't afford to lay out $4,000 to fix your existing car. So what happens to your DTI or your debt to income ratio at that point?
Well, that 47 that you got when you bought your house when it was underwritten, it's now sitting somewhere at a 57. Now, you can still make that payment, right? You're officially one problem away from becoming an NOD, a notice of default.
Right.
Seriously, if you have no savings, no history of savings, and no ability to save, as we know, and 57% of you have under $1,000 in your bank account right now, MGIC would be foolish to underwrite that MI because you're a kid's broken arm away or a new roof away from a foreclosure. The ability to make your payment should not just be to make that payment. If you can't save money, it should be the ability to deal with crap life throws at you and make a payment.
That's right. So now MGIC is saying, in their words, we're concerned. Because this is what they see. And expect other PMI companies to follow suit on this, guys, for sure.
Or to follow suit and raise rates for ratios that are over 45% with sub 700 scores. Which is kind of funny if you think about this, Frank. Think about this. The solution to allowing you to tax yourself to your earlobes financially with your house payment is to charge you more money.
That's what they're gonna do.
That's what
they're just gonna raise the premiums on those
Right.
things. So here's why we said you're all so doggone smart out there.
All right.
Check this out. One of our viewers, Joe Bystricki, I hope I'm saying that right, Joe, of AFN Mortgage out of Medina, Ohio, said this. I agree with adjusting the PMI cost for higher ratios. However, I feel they should be offset by reducing MI rates when DTRs are below, say, 25 or 30% on the back end. Wouldn't that make sense? Give us more reasons to push toward homes people can afford.
Handsome fellow there, isn't he?
Stunning, like I said.
We had to get that picture from Facebook. He didn't have a professional pic on there. But I wonder if his wife is actually wearing a 49ers jersey.
Let's hope so.
That would be super cool. Anyways, what a novel idea Joe had, isn't it? Reward those who behave responsibly, who then become extremely low-risk candidates for foreclosure because ratios are, say, I don't know, in their 30s. Under 30. Because ratios are, say, I don't know, in their 30s. And premium price those who would rather have their gobbler permanently over the chopping block with 45 plus ratios. It's like car insurance, guys. You get a good driver discount if you don't get tickets and crash. You're low risk. But if you're Bobby from the Bayou and you think you're driving the General Lee and you've had a couple encounters with Boss Hogg and Roscoe while hopped up on a little shine, then you probably need to pay more because you're high risk. It makes sense to me, Frank.
Up on a little shine. The reason it won't work is, number one, it'll appear as if you're punishing the poor because ratios get higher quicker if you don't make a bunch of money. And that is true. And the other problem is home values have gone up so much more than your income, that the average housing expense for the average family on the average home is north of 40% on the DTI. Meaning, as it stands with current underwriting guidelines, the only way to keep home values pushing north, which for some reason is what we herald, is to allow consumers to keep pushing themselves ever so close to financial ruin by stretching ratios to where you can barely make the house payment, provided life doesn't throw you any curveballs. Problem is, of course,
well, you know, life, it throws you curveballs now, doesn't it? All the time. Frankly, we understand why MGIC did what they did. But it's only half solution to a problem that's gonna become really real if we don't do something about it. That being affordability, or rather unaffordability, in the housing market. The real solution is what Joe from Ohio said. Charge the ratios. Higher rates, higher ratios. Lower rates, lower ratios. Give loan officers, realtors, and most importantly, consumers a cash incentive to buy responsibly.
Right, because going off cliffs, as we know from 2008, man, just really sucks.
It does suck. I remember that. Yeah. It still sucks.
Let us know your thoughts on the show down below. Really appreciate your comments. They're awesome. Joe, that was awesome to be able to bring that up on the show. Leave them down below. Do us a favor, forward, share, and subscribe. Don't miss that webinar on reverse mortgage. If not for your business, like Brian said, just for your family, for goodness sake.
And by the way, what we're going to be doing is Feedback Fridays. So leave comments because yours might be shared on Fridays.
Feedback Fridays. That sounds like a great idea. Subscribe for free in the upper right-hand corner. We'll catch you guys later here at the National Real Estate Post.
Later, skaters.
Bye.